contracts. Got it. Okay. So again, welcome. This is bidding for federal contracts, Federal Contracting Readiness Program overview. My name is Kelly Krieger-Hurrah. We're excited to have you join with us, Eric Ruffin, for this session. This will be an interactive session and recorded. So we encourage you to ask questions. When Q&A opens, please raise your hand using the button at the bottom of the page. And Chris and I will call on you and unmute you. If you wish, not to speak and you'd rather just put that in the chat, you're welcome to do that. And we'll get the questions when they come in over to Eric. And you can read more about Eric in the program. And Eric, I'm going to turn this over to you.
Sounds good. Thank you, Kelly and Chris. It's great being here this morning. So good morning to everyone here. Today, what we're going to talk about is our company. Let me give you a little background about who we are and what we do and all of that good stuff. We're a consulting firm based out of Nashville, Tennessee. We've been in business since 2004. And our ultimate goal of our niche business is that we service pretty much federal contractors. Probably 70% of our clientele, customers, they do business with the federal government. The other 30%, if they're not doing business with the federal government, if they're doing it on the small level, they're trying to get into that arena. Because the ultimate goal with us is that we're trying to help our firm diversify revenue, especially during this pandemic time that we had over the last year or so. All of our clients that were doing business with the federal government, they pretty much breezed through the pandemic because the federal government kept spending money. Their contracts were either extended or they were able to keep on with those contracts. So they wasn't so heavily dependent on the commercial area and different things of that nature. So we always try to tell our customer or teach our customers to get into the federal arena. However, it is a lot of red tape when you get into the federal arena. Your accounting system has to be in compliance. You have to know how to bid and estimate on federal contracts. You have to go by different Department of Labor, the Service Contract Act, Davis-Bacon Act. A lot of these things you may not know, but that's what we're here for. That's what we do. We teach our clients how to be prepared to be a federal contractor and how to be successful through the federal contracting process. One of the programs that we have right now is called the Federal Contracting Readiness Program. We have a contract or a grant with SBA where we provide an 8-week training program to potential firms that's trying to get into the 8A program. We have you fill out an assessment form. After you complete that assessment form, you go into one of our different tracks that we have based on where your company is at that present state in time. If you're kind of a just startup business, you haven't been in business for a couple of years, you don't meet the criteria of being ready, or what we call it federal contracting ready to apply for your 8A certification, we put you in track 1. But we're going to go over all of that in a little bit more detail. But ultimate goal of what we're trying to do today is bring to your attention our federal contracting readiness program, and then also tell you a little bit about estimating and bidding with the federal government, which is one of the key components of our federal contracting readiness program. So basically, we're trying to give you an appetizer so that you can get interested and hopefully join our program, which is free of charge to you. The only commitment that's required of you is to be 1 week, 1 hour a week, where you have to dedicate time to be part of that program. But we're going to talk about that in a little bit more detail. But basically, we enjoy working with small businesses. Most of our clients that start with us, they never leave us because we grow with our clients. We have clients that started back in, one of our first clients that started with us back in 2005, a construction firm. I'll never forget this firm. They're still our client today. They started off only doing about $100,000, $200,000 a year. Now they're doing over 50 million and we're still servicing them. So we started off very small with them, but we continue to grow with them as they continue to grow because the services that we offer are vast in what we can do to help you pertaining to the accounting, consulting, and business development end. And if you want to read more about what we do and how we do it, you can go out to our website. It's www.ruffin, RUFFIN, P as in Paul, C as in cat.com, www.ruffinpc.com. But without further ado, we're going to go ahead and get rolling. All righty. Any questions, as they stated at the beginning, feel free to pop it up in the chat. We'll answer the question right at that moment. It might engage more conversation to try to make this feel as more of a one-on-one type or in-person class rather than a virtual class. Okay, so let's get rolling. So the Federal Contracting Readiness Program, that's what we're going to start off with here. It's a 2-month commitment, pretty much 8 weeks. A lot of times we might go up to 10 weeks, just depending on how the group of firms that's in that particular class are grasping the information that we're going over, or if we have to spend extra weeks on a certain topic, or you all might just want to spend more time with me. So a lot of times it's all based on that group of participants within that program. But what are you going to learn when you're in that program? You're going to learn, is the federal government the right fit for me? Because the number one thing you should do anytime you're trying to think about if I should go into this line of business, if I should try to go after this particular customer, you want to know, do they buy or sell what I produce? Are they buying my goods and services? So a lot of times you got to do a feasibility study or do some type of market research to figure out, hey, do they buy what I sell? How do you do that? There's a lot of free databases out there. You're going to hear about all these different databases out there when you get into when you go register in sam.gov, where you'll hear about GovWin. That's a paid service. You're going to hear about, but everything they use to get contract information of who won contract, they get it from a free service. It used to be FPDS, Federal Procurement Data System. Now all of that is transitioned to the sam.beta.gov site. So you really want to look at this information and figure out, do they buy my goods and services? That's how do you determine if it's the right fit for me, okay? Understanding your potential for success. The number one thing about getting into the 8A program, and this is a small business development program, is over a 9-year period. The number one thing, they want to make sure that that company is vested into their business. A lot of times, that's why they look at a number of things. Hey, have they been in business for 2 years? Do they have tax returns for the last 3 years? Do they have financial statements? All of this information they look at to make sure or to see your potential for success, because they want to see, do you already have customers? Are you only heavily dependent on one type of customer right now, that if that customer leave you, you'll be out of business? They're going to look at all of that to determine what your potential for success is. Not saying that you got to be doing $5 million worth of revenue right now. However, you have to show them, hey, this was my revenue in 2017, 18, 19, 20. It's climbing up. However, maybe in 20, I had a bad year because of COVID. You got to be able to explain that. So they're looking at all of that data. A lot of the data, no matter what certification you go after, guess what? They're always going to ask for accounting. They're always going to ask for your financial statement. They're always going to ask for your tax returns. That becomes so important. And that also becomes so important when we talk about estimating and bidding. All of that information that you use to give to third parties, like getting your certifications or whatever, and also when you're bidding on contracts, all of that financial data becomes historical data that you use to make good informed decisions about your business, okay? That's why it becomes so important. That's why a lot of people say that you should invest in your accounting system, that you should invest in your IT system. All of those key components to get you set up for success in the future. And you might ask me, Eric, why, if I'm just a small company, why can't I use Excel? A lot of times we're going to go over that because when you get into the federal arena, there's certain things that could happen to you. You can go through an audit. Defense Contract Audit Agency come and do an audit on your accounting system. And if you're not following the federal regulations, guess what? You could have won a contract, but they could not let that contract to you because you don't have a federally approved accounting system. You don't pass the pre-award survey. That's why that becomes so important. That's why we show firms that the initial phases of trying to get into the federal arena, that you need to invest in the accounting system. It may only be just QuickBooks right now, but that same structure, no matter if you move to a accounting system like QuickBooks or you move to an expensive system like Deltek that costs you $50,000 a year, the structure and the foundation is still the same. You still follow that standard form 1408 to set up your accounting system. We're going to talk about that. Okay. So what else are you going to learn in this process? We talked about if you go into track 2, we're going to help you through the process of getting your 8A application submitted. Okay. FAR 9. FAR stands for the Federal Acquisition Regulation. It's a lot of federal acquisition regulations that you'll learn throughout the process with us. Well, but one of the most important federal regulations is FAR 9. It talks about being a responsible and responsive contractor. We're going to explain that whole process to you. We're going to explain to you what does DCAA stand for, Defense Contract Audit Agency. If they come in and do an audit on you, what you need to have prepared. We're going to talk about that. Then after you get your 8A certification, before you can win, before they'll let one federal contract to you, you got to have an approved business plan. We're going to be proactive and show you how you get ready to make sure that your business plan is going to be in order, so that once you get that 8A certification, you got your business plan ready, you ready to start rolling and start getting federal contracts. We're going to show you how to get market research, that if you're going after an opportunity, how do I determine who was the incumbent? How do I know what the previous award amount was? How do I know if this federal agency is just going through the motions and they're probably awarded back to? How do I get all of this information that I need to be able to know if it's a bid versus no bid decision? We're going to talk about that. We're going to talk about how you develop a capture strategy, how I'm going to capture federal contracts. Is it going to be via sole source contracts? You may not know what sole source contracts are, but the gist of sole source contracting is that when you're in the 8A program and you've done your market research and you figure out that, hey, I'm in Nashville, Fort Campbell is right down the road, right? I determined that they buy my goods and services. Now, after I found out that information, how do I win a federal contract? What type of set aside can they use to award that contract to me? One of the most effective ways and less costly on you is sole sourcing. That's one of the main key reasons of getting into the 8A program. How does sole sourcing work? What happens is you determine that that agency buys your goods and services. They have a requirement or solicitation that comes down. You know, okay, you built a relationship with that agency. That contract is less than $4 million over 5 years. If you're in the 8A program, they can do a direct award to you. Through the SBA, they award the contract to you. No technical proposal or very little technical proposal you have to write. Only thing you negotiating with the federal government is your price. You might say it's going to cost you $3 million over 5 years for us to perform this service. The federal government might say, hey, that's over my government estimate. Since it's just you and them bidding, there's no other players within this solicitation, they might ask for what? Costing and pricing data to support your bid. You got to know how you pull that data together, how you develop your overhead rate, how you develop your fringe benefit rate, how you develop your G&A rate, your multiplier. You might say, Eric, I'm making a lot of money. I got $1 million in my bank account, right? But you might just say, hey, I get my direct labor, I get all of my direct costs, I just multiply it by 2. I say my direct costs are $5,000, I multiply it by 2. That means I'm gonna charge my customer $10,000. You might be making money, but that's not an efficient way of doing it because you don't know why you're multiplying it by 2. You should know what is the makeup of that 2, that multiplier that you come up with. Because the reason is because when times get tough and the market economy slims down and everybody's just not winning contracts out here, It's the ones that understand their costs and know their overheads and so forth, that can give the most fair and reasonable price to the government and still make money. Those are the ones that stay successful. Those are the ones that have longevity in business. Okay? We're going to talk about that. We're going to talk about the federal procurement process, the 3 different phases of it. What's one of the most key phases in that process? Get those sole source contracts, because the first 4 years of your 8A program, you can get 100% sole source contracts. What does that mean? That means if I have $1 million worth of revenue, all $1 million can come from me doing the sole source contracting, just like I described, where I go to that federal agency, we're able to get a bid through them, bringing it through the 8A program. But you got to remember, the 8A program is a 9-year developmental program, right? So after 9 years, they want to make sure that you what? That you got past performance, that you got a good, strong foundation that, hey, after these 9 years, I won't be so heavily dependent on sole source opportunity, because I won't be able to get them via the 8A program. I might be able to get them through Women On or Hub Zone or something of that nature, but not through the 8A program. So in year 5 through year 9, what happens? They try to wean you off of so many sole source contracts. They say, hey, now in year 5, you got to show that at least 15% of your revenue is coming from non-sole source contracts. And every year after year 5, it goes up 10%. So I got to show them, hey, I'm getting other contracts through commercial, through residential, through state and local government, whatever it might be, because now I built up my past performance and I can go after other opportunities now, right? I understand it better. I understand my costs better. I'm going to teach you that. Then we're also going to teach you about strategic alliances, joint ventures, mentor proteges. Because honestly, most of the people that's successful in these programs, because you don't do business with people unless you know them, right? So a lot of times to get your foot in the door with these different agencies and so forth, you got to have somebody that already know them. That's where those strategic alliances come into play. You might get with a firm that's already graduated from the 8A program that's built those relationships. But because they graduated, they can't get to those 8A dollars anymore. So that's how those strategic alliances form. Hey, I got my 8A certification. I got some past performance in certain areas. Hey, but I need my foot in the door. Because I'll tell you this, once you get your foot in the door, which is the hardest piece, if you do a good job, they're going to keep feeding you. Most of our clients, they only do business between 1 to 4 agencies. That's usually enough, especially if they do a good job, because especially as you continue to grow, then you get into that 4th quarter when the government don't have time to what? Put the solicitation out for bid, because it could take 3 to 4 months for them to go through a procurement process, right? But they only got 2 months before they lose the money. If they already know you do work, they already got a relationship with you, you'll get a phone call and say, hey, I got this contract. We need to sole source it to you. That's how easy it is sometimes after you get your foot in the door. Because from July to September 30th, that's the government 4th quarter, and that's when they spend the most of the money. That's why those first 3 quarters, you want to be out there marketing, building those relationships, doing all that good stuff. And that's what we're going to teach you. How you do that, how you get all your market research so that you can develop that capture plan of how I'm going to capture contracts, how am I going to get strategic alliances. Well, should I use a joint venture relationship? Should I do a mentor protege relationship? We're going to talk about all of that. So if you're interested in it, we will send you after the meeting, we will get the list of all the participants in this program in this session today. And we'll shoot you an email with the assessment form. You complete the assessment form, provide the additional documents that we request. And then once we get all of that back, we will place you into track 1 or track 2. Track 2 participants, these are ones that we assess that are pretty much ready to go through the federal, ready to submit their 8A application. So we're going to take you through that process of helping you submit your 8A application, but also over those 8 weeks, teaching you about the federal arena, about all these different things that we talked about up here. If you get assessed and you go into track 1, that means you're not quite ready for submission of your 8A application, but we still want to train you about the federal arena and see if it's the right fit for you. And then hopefully at the end of that, you're ready to move into track 2. But that's the gist of the 2 programs. And then track 3 are for 8A firms that's just love rough and consulting. Sometimes they want to do a refresher course on certain things that we address pertaining to like accounting, estimating, business and development, whatever it might be. And SBA rep might call us and say, hey, this firm is looking for this training, and that's what track 3 is for. It's for firms that's already in the 8A program, okay? For firms that are not in the 8A program, you will be assessed in track 1 or track 2. All right, any questions? No, it was a mouthful, but hopefully you all got the gist of that. And now we're going to move into talking about estimating and bidding in the federal arena and give you a high-level overview. Can't make you accountants the first day, but what we definitely want to do is tell you about so that you can be aware of exactly what you should be expecting from your accounting function, your estimating team, or whoever it might be, so that you are more aware of how you should be using this data or the data within your business to be able to successfully win federal contracts or commercial contracts. We're talking about federal arena, but no matter if you're in the federal arena or you just do a commercial, whatever, you should still have an estimating process that you use. All of our clients, no matter if they're federal or commercial, we still set up their accounting system the exact same way. So let me ask you a question. Do you think if we set up an accounting system to help you estimate and bid, will it be more expensive if you got 1 employee when you're first starting out or 500? Of course, it's going to be more expensive. You got 500 employees, right? Because there's more stuff we got to look at, more timesheets more time tracking, more employees, all of that information. It's going to be more data. But the foundation we use when we set up an accounting system, no matter if you have 1 employee or 500 employees, it's the exact same. How we segregate your different chart of account line items, how we set up your time tracking to map with your general ledger. It's still the same foundation. That's why we always make sure that firms understand, start this process early. It's an elephant. How do you eat an elephant? 1 bite at a time, right? So that's why we tell people all the time, we grow with you. We know a lot of times your budget may not be large enough to do everything all at one time, but however, you can piecemeal it to get to the point where you need to get to. And that's all you want to do, is try to make sure your business is going down the right path to be successful in the long run. Because when they start coming in, those contracts start coming, you don't want to have to worry about your accounting system then. You want to worry about, hey, let's doing a good job on this project. So, hey, because mama need new shoes for Christmas, right? It's time to make some money, right? I done invested, I done put all my time, work, and ethics in this. Now it's time for the payoff, right? So that's why you want to make an investment in certain things right now that you know that you're going to need in the future. Okay? All right. So a well-designed accounting system, a lot of times we always say it's essential for any business to ensure that key information about the company can be developed and communicated to managers, project managers, owners, customers, creditors, auditors, all of those people who's involved in decision-making. A lot of times you see that in accounting. You might see these financial statements, tax returns, and you might see that the banks ask for it when you need to get a line of credit, or when you're going after these different certifications, women-owned, HubZone, Service Able Vet, 8A, whatever it might be, third parties are asking for them. But they're truly not for them. They benefit from it, but that data is truly for you as a business owner to see that data, to be able to make corrective action if it's something that's going offline, or so that you can see how you're doing on a particular job, right? so that you can use that data in the future that, hey, if I work all of these types of jobs all the time, right? That means that, hey, I know exactly what it takes. I got historical data that it took this much labor, it took this much material, took this much travel, whatever it might be, so that when I bid something very similar in the future, I got a competitive advantage on my competition, right? Because I truly know what it took. Then I know how much my overhead is. I know how much my G&A rate is. I know how much profit is there or I need. So all of that becomes so important, right? But a well-designed job cost accounting system, you see, we say job cost. We just don't want to send our bank statements to our bookkeeper and say, hey, reconcile my books. And then I get my balance sheet and P&L statement for June in September. That's old news. Information should be going in timely so that I can click a button anytime and see how I'm doing. Not just as a company level. Yes, I want to see how my company is doing, but I want to see on the individual job basis, because that helps me determine what? If some jobs are not profitable or which ones are, that when I'm bidding on future jobs, I'm going after the ones that are more profitable than the other ones, right? I might have to phase out an industry if it's not profitable. But the only way I know that is by what? Looking at that data. I think I know data well. I think I'm a CPA and all of that. But as much as I put it in my head and I say, okay, I think I'm doing this on this job, until I really go look at the data in my accounting system, I'm still off. So that's why it becomes so important that you set it up right so that you as a business owner can make good informed decisions about your business based on the data that you're looking at. Okay? But if you put junk in, you're going to get junk out, right? So that becomes important from you to make sure that data is going in there properly and data is being analyzed and reviewed in a timely fashion. Okay? All right. Any questions? So when you're talking about developing an accounting system, the number one thing you should do is the first thing is always analyze what you got going on first. If you said, Eric, hey, I want Ruffin Consulting to come in and set up us a DCAA compliant accounting system, Defense Contract Audit Agency compliant accounting system, we're first going to ask for access to your system to see what you got going on. That's the analyzing. Then we're going to design it in compliance with the standard form 1408. We're going to show you an example of that. We're not going to go in details of each line item, but the gist of the standard form 1408 is that they want you to have a job cost accounting system. Then they also want you to make sure that you're segregating your costs by direct and indirect costs. We're going to talk about what are indirect costs. Then you implement, right? That means implementing your accounting system, your estimating system, your payroll system, time tracking system, all of that is one function, right? Then what's the only thing that's constant in life? It's change, right? As you continue to grow, things might change in your business. So every year, you should be looking at what? Your policies and procedures. And all of this, after you implement your accounting system, what should happen? It should be documented. You should have policies and procedures documented. Why? Because you might hire me as the accountant. But what's always happening in companies? Job rotation or people leaving. And so if I'm the only person that know about the accounting function in your business and I decide to leave and go to Hawaii because my wife hit the lottery and I take everything with me, what happens to your business? That's why you're paying your employees. You make sure everything is documented. Because if it's properly documented and that person decides to leave, what happens? long as you bring in somebody that has an education in accounting or bookkeeping, they should be able to take those policies and procedures and your business keeps flourishing. No question. That's why we highly recommend that everything is documented. Because if you go through a federal audit, the number one thing they're going to ask for is your policies and procedures, your AOPs, accounting operating procedures. They're going to make sure what you say is going on written in your accounting operating procedure is actually happening. And you got to show them, hey, this is what I say in my procedures, and this is how it's being done in my accounting system. You have to show them examples, right? And one thing about accounting is always you want to make sure you follow the term consistently, consistency. Either I'm consistently right or I'm consistently wrong. And the reason I always say that, even if you're doing something wrong and you do it on a consistent basis, what happens? If we got to correct it, it's still an easy correction. But if you flopping it, this month I depreciate something straight line or I depreciate something double declining or whatever, if you flip flop doing different things, it's hard to correct. So always remember that term, consistency. Okay? But that's the flow of an accounting system. But we always doing follow-up. You always trying to make what? Process improvements. Because ultimately, at the end of the day, you want true efficiency. You might say, Eric, what's the best accounting system out there? And it varies, right? Varies what industry you're in. It's certain accounting system that's for construction firm or professional service firms or whatever. But if you're just starting out and the budget doesn't allow for a large investment into an accounting system, QuickBooks is always the best option. Don't ever let somebody tell you that QuickBooks cannot be set up for federal contractors. That's not true, because it's all about the structure and the foundation of it. Now, QuickBooks is not as automated as other accounting systems that cost you $30,000 to $50,000 a year. But QuickBooks only costs you, $1,000 to $3,000 every 3 years. If you use the desktop version, right? Online version might be $1,000 a year, right? So cost versus benefit when you first starting out, QuickBooks is probably the best option. But you're not going to have a lot of automated things that you need or that would make your life easier when you're in the federal world. Like if you want to be able just to say, compute your overhead rates or say, what's my multiplier? You can't do that in QuickBooks with a click of a button. We can get everything set up that you can take that to Excel. We show you how to do the math really quickly and you know it, but it's just not automated. That's the cost of the system, right? So any system, you'll hear all the different accounting systems out there when you get into it. If I'm in construction, you'll hear about foundations. If you're in professional service, you'll hear about Deltek, Uninet. You'll hear about some other ones out there, Mass 90, right? Aspire, Procast, all of these different accounting systems. All of them are different levels of accounting systems that makes your life a lot easier when it comes to automation. And you might say, Eric, why would I spend $50,000 on an accounting system when I can just spend $1,000? Because think about it, as you continue to grow, you have 300 or 400 employees. You don't want to be doing manual entry. You might have an employee that you can get rid of because you're using QuickBooks when you move to another accounting system, because a lot of his or her functions become more automated. So a lot of times those systems pay for themselves and it makes life a lot easier. But you have to do that cost versus benefit analysis. Okay? A lot of times you might say, Eric, when do a lot of firms move from QuickBooks to another accounting system? We see it a lot of times when most firms get over about 75 or at least over 100 employees. A lot of time, if you're in the professional service industry, a lot of them start moving to systems that are more automated. That's when I say more automated, I'm saying that it's all one system. Because in QuickBooks, it doesn't have a full time tracking module right with it. You can use QuickBooks Time and so forth, and it's a sync process. But you have some systems that have everything built in, the ERP system all built into one, which leaves room less room for error, right? You mitigate a lot of errors. Because when you have to go from one system to the next, room for error, right? Or when they're not all as one system. Okay? So the cost accounting system, or it might be called a job cost accounting system. If you're awarded a federal contract, that contracting officer, that KO, or whoever they might call themselves, could say, we want a pre-award survey done on your company before they actually let the contract to you. And a lot of times when they say that, they're trying to make sure that you have an accounting system, that you are set up properly, just in case something goes wrong or something else happens on that contract, that you can properly perform. They might also ask you to complete a standard form 1407, a financial capability. That's almost like a personal financial statement for your business. They want to make sure that you got enough working capital, that if they give this contract to you, that you won't be out of business tomorrow, that you got enough to meet payroll. Does that mean I got to have a bunch of money in cash? No, but you got to have access to capital, like a line of credit, a loan, might be a factoring relationship. Okay? So the standard form 1408, if they came and did an audit on your accounting system, this is what the Defense Contract Audit Agency uses. So this is what we use to what? Set up your accounting system. So at the end of the day, we want to, after we set up your accounting system, we want to be able to answer yes to each one of these items on this list. And the number one item is that your accounting system have to be governed by generally accepted accounting principles. That means what? It can't be on the cash basis of accounting. You might say, Eric, hey, my tax person does my taxes on the cash basis. That's fine. But for internal purposes, you got to be on the accrual basis of accounting. That's generally accepted accounting principle. What's the difference between cash versus accrual? Let me tell you. Cash basis, give you an example. Say I have a client. I work for that client. From I bill them monthly. So from July 1st to July 31st, I work. I provide professional service. I bill them an hourly rate. And so say for the month of July, from July 1st to July 31st, I work so many hours, and I'm going to bill them $10,000. Right? Okay. That means on July 31st, I send the invoice to my customer. Right? So what happens in this? In my accounting system, I create this invoice. If I'm on the accrual basis of accounting, guess what happens? I create the invoice. On my balance sheet, it creates an accounts receivable because I've earned the money at that moment in time. So it's revenue, right? So I have an accounts receivable on my balance sheet, and on my income statement or P&L statement, I have revenue, that $10,000 because I earned it, right? That means the accrual basis of accounting is recognizing the receivable and the revenue. But on July 31st, if I'm on the cash basis of accounting, what happens? Nothing goes on my balance sheet and nothing goes on my P&L or income statement. Why? Because I don't recognize the revenue on the cash basis until it comes in. They may not pay me until I sent the invoice on 8/2. They may not pay me until 8/31, right? If I have a 30-day payment terms, right? So that means I wouldn't recognize the revenue and the cash until a month later. But if I'm trying to go to the bank to get a line of credit, or I need to show my financial statements to SBA for my 8A certification, if I'm on the cash basis of accounting, I have nothing on my balance sheet or P&L statement on 7/31. But on 7/31, or if I'm on the accrual basis of accounting, I got the $10,000 as a receivable on my balance sheet and that $10,000 on my P&L and income statement. So that means the accrual basis of accounting shows what? exactly where you are at a moment in time. Cash basis doesn't. That's why it's not a generally accepted accounting principle. Okay? That's one thing, one aspect of what you want to start doing if you're not doing right now. I got to get on the accrual basis of accounting. I got a bookkeeper or accountant. That's the number one thing I want to tell them. Then number two, you got to say, I say these are your first two items. Segregate your costs by direct costs and indirect cost. We're going to talk about that. Everybody should know we're going to talk about what are direct costs, what about overhead, what are the indirect costs. We're going to show you exactly what those are and how this all leads to us producing an estimate at the end of the day. Because it all stems from your accounting system. Remember how I said everything is joined together? You're using all these systems to be able to produce something at the end of the day. Okay? So what you should gain out of this is that I need to make sure that my accounting system is going in this direction by utilizing the standard form 1408. I'm not going to go over each item on here because I could spend a whole 8 hours on each one of these items. We have classes strictly just on the standard form 1408, but what we're trying to get you to understand is strictly that you need to understand. You need to put this in the hands of your person that's handling your accounting. Okay? Time tracking becomes important. Having that accounting system, having a time tracking system, all of that is what the standard form 1408 is stating. Okay? All right. We'll be able to share all of these documents with you. That's probably going to be a question that happens. Everything that we go over, the slides and the handouts, we will be able to provide to you after the meeting. We'll get with the team that we have here and let you know how that's going to be distributed, or that might be something that we discuss after the presentation today. All right. Any questions? Not one question so far. That means I'm either doing a great job explaining or I'm giving you too much information and your mind just still turning. So if you have any questions, feel free to chime in, because I know if you're thinking about it, somebody else probably is as well. And it helps me try to make this a little bit more engaging. But hopefully you're learning some things, but we're going to keep moving down this path, okay? All right. So your chart of accounts, they can't be too specific. You should always use account numbers because that helps easily explain my assets, my liabilities, my revenues, my expenses. All should be number coded. And there are short course to reorganize chart of accounts, and these are different things that we're going to show you, okay? So you should always have written timekeeping policies and procedures. Why is that important? Because you always want to know how is labor being accumulated? What projects are accumulating the most labor? When you're correcting and filling out timesheets, all of this, you got to explain to them what happens. The manager has to sign off on timesheets before they get approved. Then what happens? Okay? Then once it's approved, then it rolls into what? Payroll processing. So all of your written timekeeping policies and procedures are important to make sure that everybody's getting paid the right thing for their hours, the right rate, and it's properly documented, and we have a clean audit trail to everything. Because you're going to get into the federal arena, and what's going to happen? You're going to get on federal contracts where you might be governed what they call the Service Contract Act or the Davis-Bacon Act, or it might be part of a collective bargaining agreement. And when all of these things are, when a federal contract is governed by certain these different acts, it's certain rates that you have to pay, it's certain vacation you have to give, it's certain sick hours they accumulate. And then in addition to that, sometimes you have to pay them an additional wage. If you don't have a full benefit package, you have to pay them what they call health and welfare. You have to pay that on every hour. No matter if it's a vacation, a regular hour, holiday hour, vacation hour, or sick hour. you got to pay that minimum wage. That H&W rate right now is $4.22 an hour that you have to pay in addition to that regular rate. I had a client one time, I'll give you an example. I had a client call me one time and said, hey, Eric, DOL just called me. And this was before we met each other a few times. I think they've been to a couple of our workshops and different things of that nature. But he said DOL called me, but he wasn't a monthly client of ours where we do regular work for. He called me and said, hey, Department of Labor called me and they said that they're doing an audit on me because they don't think I've been paying H&W. I don't even know what that is. So I said, okay, send us the contract, the executed contract. We said, send us your original estimate that you submitted to the government and so forth. All of that we wanted to look at. Why? Because I wanted to look at the contract to make sure that it was governed by the Service Contract Act. Then I wanted to look at his original estimate to see if he or she was telling me the truth of maybe did they include the H&W, but they just decided not to pay their employees. But we're looking at all of that, we realized that, hey, they just didn't include it because they weren't aware of it. But one thing about the federal government, ignorance is not an excuse. Because if you signed on the dotted line, that means that you are implying that you read everything in this contract and you know exactly what you should be doing. So this contract has been going on for 3 years. And they haven't been paying that $4.22 on any of their hours for these employees over all 3 years. But one good thing, whenever you go through an audit or whenever you go through anything like that with an agency, you always try to be as responsive as you can and let them know that you're not hiding anything. You always want to be upfront, as transparent as you possibly can as well, because it might help you in the long run. So one good thing that I noticed that he was doing is that in that wage determination under the Service Contract Act, you go to the Department of Labor, you pull out what they call a wage determination. This tells you by labor category, what's the minimum wage you should be paying for each labor category. So if these were janitorial people, the minimum wage probably was $12 an hour. He might have been paying $14 an hour. So one good thing was he was paying more, but it wasn't because he was thinking it was for H&W. He just was paying them a little bit more because he was trying to get good qualified people and not to have a lot of turnover, right? But we were able to analyze that and show the auditor that, hey, the minimum wage said this, but he was paying this. They don't have to give you credit for that. But because we were timely in our responses and so forth, it counted that. So the essence of this story is that this company ended up having to pay more than $500,000 out. Most companies, that would sink them. They would be out of business. But luckily, this company had enough working capital, had enough money in the bank to be able to pay these back wages. But a lot of firms, that wouldn't be the case. That's why it becomes so important that you truly understand everything you're bidding on. Because that's why we say sometimes a no bid is your best bid if you don't truly understand it. Okay? Just a little example. Any questions? So we always say to win a federal contract, you got to think like a federal buyer. You have to be a low risk contractor. That means that they want to make sure, that agency wants to make sure that you're going to meet every deliverable on that project. You're going to exceed their expectations and you're going to give them stuff in a timely fashion. If they ask for transmittals or reports or deliverables or whatever it might be, you're getting that. Then you should also know they're going to pay you usually. It's a small business provider. Usually you get paid within the first 15 days. Sometimes you got to know who you need to talk to. You might have to know what system you use and how you're going to do your invoicing. They use different systems like wide area workflow. Some variety of systems you could be using out there to do your invoicing for a particular contract. But you got to think, you got to be a low risk contractor. everything you do pertaining to getting federal contracts, a lot of times is always based on relationships. In relationships, the better your relationships helps you to say that I'm a low risk contractor. Why? Because they know who you are. They know what you do. But ultimately, you still got to figure out exactly how am I going to get my foot in that door to be able to show them I can do the work and I'm a low risk contractor. I'm going to give you a fair, reasonable price. I'm going to come in and do the work and meet all my objectives of the contract. Everybody's going to be happy at the end of the day, right? This is the federal procurement process that we'll talk about within the 8-week training program. Basically, it's 3 phases: the acquisition phase, the solicitation phase, and then the award phase. All of these different key components of this is what we'll be talking about. Too much information to go over during this call today, but we want to make sure that you truly understand that it's a 3-phase process. That acquisition phase, that solicitation phase, acquisition phase, when they're thinking about or when they're trying to say what type of set aside it's going to be. When you get those different sources saw and they say they need you to respond to it so they can know if it's going to be 8A contract, what type of contract it's going to be. Then the solicitation phase, when they put it out on sam.beta.gov, right? When they say if it's a firm fixed price contract or time and materials contract, whatever it might be. Then the last one is the award phase. Hey, we won the contract. Now we got to start it up. Now I got to make sure my quality assurance is there. One of the biggest things about a contract, a lot of times, they want to know what is your QASP, your quality assurance plan. Why? Because they know we're human and we're going to make mistakes. But if mistakes happen, what's going to be your corrective action? How timely are you going to be in responding? That's what they want to know. So it's really 3 different types of federal contracts, and a lot of additional types of contracts stem from that. If you don't know them, you usually always have your firm fixed price contract. Everybody probably knows this. They say to paint this room right here, they give you the scope of work. They say they want you to paint this room, do all the crown molding, do all the trim and everything. You tell them it's going to be $10,000 to do it. You win the bid. When you invoice them at the end, all you're getting is $10,000. If you underestimated the amount of material, the amount of labor, and it ended up costing you $11,000, you got to eat it, right? Because that was your fault in bidding. That's a firm fixed price contract. Time and materials contract, that's hey, if I come up with, I'm paying my employees $25 an hour, then I add on all of my overhead rates, and I ultimately get to I'm a bill, my fully burdened rate is $50 an hour, then I'm gonna bill my customer. You get to bill them the $50 an hour, but you only bill them for billable time. That's why that time tracking system comes important. Why? Because your employee every day should be filling out that timesheet to say, hey, I spent 8 hours working on this project and it's billable. Then if I take vacation, I take 8 hours, but that's not billable. So at the end of the month, if he has 170 hours that he's getting paid for, but only 162 is billable, 8 hours for vacation, you get to bill the 162 times $50 an hour, right? That's time and materials. You bill for time. Then also on materials, materials mean like if they have another line item within that contract, like for materials, like ODCs or travel or different things of that nature, you get to bill those at cost. So if somebody travels, they got to have all their support. They travel from here to Knoxville. They got per diem. They stayed at a hotel and that came to $500. You pass that on to the government for reimbursement. That's the material side, right? The cost reimbursement type contract, that's your 3rd phase. You might hear it called cost plus or cost reimbursement type contracts. The gist of these is that, hey, all of these different overhead rates that we're going to show you in a second, when I say that my fringe benefit rate is this, when I say that my overhead rate is this, when I say my G&A rate is this, I get to pass that on to the government. That means that if I'm paying my employee $25 an hour, I show them on the invoice, this employee pay is $25 an hour times this amount of hours. I'm adding on my overhead, my fringe benefit rate that I computed with my DCAA compliant accounting system. I'm adding on my overhead rate of 7%. I'm adding on my G&A rate of 13%. Then ultimately I'm adding on my profit too. I'm passing that on to the government. So if you don't have a federally approved or DCA compliant accounting system, you don't even want to go after those type of contracts. Because what's going to happen at the end of the year, the auditor will come in before you submit that final invoice to make sure that how you computed all those rates and all those invoices that you submitted for those first 11 months agree back to your accounting system, and that you're computing it right, and that you're not overcharging the government. Because what happened on that last invoice, if that's where you are reconciled, they determine who owes who. That's the reconciliation process. Okay? So, contractor must make a decision whether to bid or not to bid on the project. And a lot of times, these are the different things that you want to consider. Do I have adequate finances to perform? Do I have the capability to perform? Do I have the available manpower? The machines, do I have to rent them or do I own them? Do I have the materials? Do I have the management, the proper management? All these things you want to consider when you're thinking about bidding on a project. Okay? So indirect costs, what are they? Indirect costs are costs that are not directly billable to a project. These are costs that you incur. They're fixed costs that you're going to incur just for your business to continue to operate. And a lot of times, indirect costs vary from client or customer, from company to company. One company will have a totally different indirect cost structure than the other. Let me give you an example of how one account could be direct, could be overhead, or could be G&A. Travel. That's why you always have to know the nature of every account. Say if we won a contract and travel was part of one of the ODCs in that particular contract. That means that when that employee travels from point A to point B, we get to bill the government for it. So in that aspect, travel is what? It's a direct cost, directly related, directly traceable to a project. But then say in another example, say I have a project manager, and my project manager oversees say I got 20 projects going on. My project manager oversees all 20 of those projects. If I ask him to fill out a timesheet and say, I spent 5 minutes on this project, 10 minutes on that project, he'll spend more time filling out a timesheet than he would be doing working, right? So a lot of times you might hear somebody say, I'll put my project manager into my overhead pool and I allocate his salary to all of my projects equally based on the methodology I might use as direct labor, right? But all of my projects get a piece of his salary and I allocate it in a systematic way. So if he travels, if you gave him a vehicle and all the gas and all the maintenance and all that stuff on that vehicle, would that be a direct cost? No, that'd be an overhead cost. Because he's indirectly related to all the projects, but not directly billable. But you use him to what? To oversee those projects. So what you want to do, the reason you put it into that overhead pool and you want to determine what that rate is because you want to make sure that you're marking up all of your projects by that rate to cover that cost, right? Then lastly, G&A. Think of general and administrative as your fixed cost. These are costs that you incur no matter if you have $1, if you don't even bring in $1 revenue, like rent. You sign that lease agreement for 3 years, right? You're going to pay that rent every month. So that's a G&A cost. Utilities, G&A cost. Your secretary, G&A cost. Your cousin that you gave a job to, G&A cost. Mother-in-law, all of them. All of those, they're doing administrative items, G&A costs, right? So think about, so that means that you got to determine, you got to know what all those costs are. And they all are segregated in your chart of accounts so that you can come up with a rate so that you can make sure you mark up all of your projects to cover that G&A cost. How do you become a good estimator and a good bidder as you continue to grow? What happens? You start thinking about break-even analysis. At what point are all of my overhead costs and G&A costs covered by my different projects? Because at some point, when you reach a certain amount of revenue, you cover these fixed expenses. So that means that after that point, what happens? Everything hits my bottom line. So that means when I'm bidding a G&A rate of 13% and overhead rate of 12%, and I've already passed my break-even point, that becomes what at the end of the day? Profit. That's how you start using this data to become smart estimators and bidders. But you got to know this. You got to have it set up properly to be able to do this. So indirect costs, I already kind of went over that. So I'm going to skip this slide because I gave you a good example of what are indirect costs. This is something that you want to talk to with your accountants, because a lot of times to be able to compute your rate, you say all of my G&A costs or all of my overhead costs are this, and they say it comes to $10,000. When you come up with the rate, all you do is say that $10,000 is in my numerator, then I always got to have a denominator that I divide by to come up with the rate. That's what this allocation base means. That a lot of times, I give you an easy example of how you compute your fringe benefit rate. Say I offer medical, dental, vision, 401k, 3% match, and so forth, right? Say all of my labor, say all of those costs for the year total $75,000. So how do I determine my fringe benefit rate? All I have to do is take that $75,000 and divide it by my total labor, because that's my allocation base, because fringe benefits is related to my labor. So when if my labor was $1 million, 75,000 divided by $1 million, that's my rate. Simple as that. So that means that if I'm offering somebody a fringe benefit, I always got to know that if I'm paying them $25 an hour, I got to mark it up by that fringe benefit rate to know my true cost of what it's going to cost me. That's how easy it is if you got it set up properly. Okay? So we gave you some examples of what could be your allocation basis. But like I stated at the beginning, it's all based on what? You have to determine it based on your business, and then you have to be consistent on how you use it. Okay? So the reason you want to develop pricing strategies, and the reason all is because it helps you with bidding on new business. It helps you with your break-even analysis. Then, if you have to do cost incurred reports, those cost plus report, that comes when you get those cost plus contracts. You got to have everything set up properly. So you'll see that people start saying, what are your actual overhead rates? Actual overhead rates mean that you always look at so right now, a lot of times people will use 2020 to say, okay, these were my actual overhead rates for 2020. But then say if things are going, you get 2 or 3 new contracts, you're adding on new labor, a new administrative assistant, whatever. A lot of people say, what are your forward pricing or your provisional overhead rates for 21? A lot of times you project out what are going to be my rates for next year. Okay? That's just the difference between those two. Okay? So an estimate, honestly, guys, is just an educated guess. But it's a guess using good data to be able to come to what my contract price, what my bid price should be based on that. Because ultimately, at the end of the day, when you compute this estimate and you win the contract, what should happen? In my accounting system, I should put that estimate in. Then I should track estimate versus actual and try to figure out, what's my estimate on? Am I going up? Am I going to make money on this project? But if I'm looking at it in a real life platform, real-time platform, I can make corrective action. Or I can see that just because I'm going over here, I'm going under here, so it's balancing out. The only way you can do that is by truly understanding and knowing your accounting system and understanding your costs. They say that you got to control it and understand it. And ultimately, that'll help you at the end of the day. So 2 things I want to go over. We got about 20 minutes left in this workshop. I want to go over with you everything that we just talked about in a demonstration so you can see how your chart of accounts should be set up, then how that ultimately goes to you computing an estimate and so forth. So let me go over this handout B really quickly with you. Don't mess up on me now. Here we go. Here we go. So everybody, hopefully you can see this. I'm gonna make it a little larger for you. Make it a little bit larger here. So basically, this is what overhead rates could look like if this was your business. 13.74. What does direct labor mean? Direct labor burden mean? A lot of times in the small businesses, a lot of companies, they don't have the personnel, they don't have the working capital or the business foundation to be able to offer fringe benefits. So labor burden represents, and a lot of labor burden represents those federal taxes you have to pay. And if not, you're gonna see Uncle Sam. And I tell people all the time, I like stripes on my suits, not behind bars, right? So we always say labor burden are those different things: FICA, FUTA, SUTA, workers' comp, general liability. You have to pay those when you have an employee. If not, you're gonna see Uncle Sam, right? So we separate those out from fringe benefits because a lot of times small business owners may not offer fringe benefits. But when you're bidding on contracts, a lot of times they combine these two together. So a lot of times you'll combine that 13.74 and that 9.90 as one rate and call it your fringe benefit rate. But fringe benefit consists of these expenses that are not mandatory, like vacation, holiday, unless it's up under those Service Contract Act or Davis-Bacon Act, they're not mandatory, right? 401k, dental, vision, all of that stuff are benefits. They are fringes or add-on things that you try to offer to your employees so that you can have a good employee base and attract the best people. But it's not mandatory like those items that consider labor burden. Then overhead rate, we talked about that. Those are the different expenses that we consider that are indirectly related to your direct costs. Not directly, but indirectly, like that manager, supervisor, and his travel and his vehicle. Then we talked about general and administrative, rent, utilities, secretary, IT stuff, marketing, all of that, general and administrative. But you'll see that everything we're doing, that's why we have it highlighted here. You see this 54,949 coming straight from my accounting system, my direct labor burden. I'm just taking that, bringing it over to the schedule to make it pretty, and I'm dividing by what? This 400,000 right here. That's how easy it is. If you got everything going into your accounting system right, all you got to do is pull it straight from your P&L statement and bring it over here and compute your rate. But it has to be going to the right accounts. Fringe benefits, same thing. Take your fringe benefits, then I'm dividing it by labor as well, because that's the allocation base. Then overhead rate, you'll see that, look, we have everything number coded. All of our revenue accounts in our 4,000 series. All of our direct costs, remember on that standard form 1408, we said everything should be segregated by direct and indirect. All of our direct costs, which are cost of goods sold, are in our 5,000 series. Then all of our indirect costs, we have our overhead costs in our 6,000, Then we have all of our G&A costs in our 7,000. Then another thing in federal contract is certain expenses they say are unallowable, meaning they're unallowable for when you compute your G&A rate. They're allowable for tax purposes, but when they say that they want to know your G&A rate, they say you have to bag these out. Different things like advertising, interest expense, entertainment, contribution, bad debt. It's a laundry list of them, but you have to bag those out when you compute your G&A rate. So we go ahead and put those as unallowable costs in our chart of account. So we'll know that when we compute our G&A rate, we don't include them. But you see, this goes back to that standard form 1408, that we're satisfying that one requirement where we're segregating our direct costs from our indirect costs, right? Then you'll look and see right here. Our G&A is 133,000, right? We taking that and dividing it by our total cost input. Our overhead rate, our overhead costs, our total 6,000 is 78,000 right here. See that right there? We taking that and dividing it by our total direct costs to come up with a rate. So that becomes so important that your chart of account is set up properly and everything is being coded so that you will be able to produce these rates. And then remember at the beginning when I said you might get a project and the direct labor, the cost is $10,000, then you multiply it by 2, then I'm gonna say, I'm gonna charge my customer $20,000. In this estimate, if they wanna make a 10% profit, their multipliers are 1.63. But they truly know that based on their rates. But if they know they can get away with a 2, they know that that additional 37% is all profit because they truly understand what they need to cover their costs. Everybody follow me? Any questions? All right. So all these other pages are how we get to it, but just wanted to go over with you that. Then the next item I want to go with you, just a sample estimate. If you knew your rates and different things, this is how it would work, right? If I had an employee, I was paying them $9, this employee $9 an hour, this employee $10 an hour, this employee $13 an hour. My SEA rate is 422. Let's say 422 for this, 422 for this, 422 for this. Then the next same example, I'm putting in my fringe benefit rate, my labor bird rate, my fringe benefit rate, my overhead rate, my G&A rate, and then got my profit. So that means that, hey, for this person I'm paying $9 plus the 422, I need to be billing out at least $21 to be able to make money on it, right? Then say, I know that my customer said that you can bill all the way up to $25 an hour. That means that, wait, I'm gonna increase my profit here, right? So I get closer to that $25 an hour, right? I don't want to change these because I want to make sure I'm covering these, but now I'm close to that $25 an hour, right? Then if I wanted to see how much money I'm really bringing in, you can go to this summary page and say, okay, I'm gonna pay out $69,000 in labor. I gotta pay labor burden. I'm gonna pay $7,000 for fringes. I'm gonna pay $8,000. Then overhead, I get to mark it up $7,000, $13,000 here. Then I got $25,000 here, right? So I should have no variance here. This minus that. Let me do it on this page so you can see it. This minus this here, no variance. So I'm making $26,000 on $130,000 profit. Is that enough money? You divide that by, say it's over 12 months. $2,000 a month in profit when I'm billing this amount every month. Not bad. But that's how you use all your accounting data to ultimately be able to bid on the contract.
Eric,
Yes, ma'am.
we have a question, if I could interrupt you for just a minute.
Yes, you may.
All right. A question, many of my clients are 1 to 2 person operations. They plan to subcontract the majority of the labor, which is not on their books year round. How do you get them comfortable with projected numbers as opposed to actuals?
One more time. So this is coming from, read that one more time for me.
Certainly. So obviously we're all counselors and we work with small businesses.
Right.
In this case, these are clients and they're very small. They're 1 to 2 person operations. They plan to subcontract the majority of the labor, which is not on their books year round since they're subcontractors. How do you get the clients comfortable with projected numbers as opposed to actuals?
Well, in that case, when they have subcontractors, I guess I gotta take this a different approach, but trying to make sure I truly understand what the question is. But the gist of, if they are subcontractors, you won't have to add on these different labor burdens and fringe benefit rates, but you will have to add on, you still got contract support, overhead, and G&A. So the essence of that is you would still follow this same logic that in this essence, you still got to pay your subcontractors a rate. So you might call this person sub 1. Sub 1. And say this person, you pay them $25 an hour. Right? And you pay this person $25 an hour. Right? You will still mark it up to, even though they're not an employee, you still got to mark it up to cover how many billable hours you're planning that they will work, say 200 hours or 300 hours here. So your total contract price will still be whatever you say is going to take to cover that cost, plus whatever you still as a company still got overhead and G&A, and then you still trying to make profit from your customer to be able to see profit on that particular project. So it's still, even if that company uses subcontractors instead of W-2 employees, they still have other costs, which are G&A and overhead outside of employee costs, that they should still be computing their rates as a business. Did that answer your question?
Yes, thank you. She said perfect answer.
Got it. Okay. Anything else? Well, we're at the Q&A session. And just like I stated at the beginning, this is all of our contact information. And everybody that's on the call, we will send you a follow-up email to go over if you're interested in the Federal Contracting Readiness Program. But that's the gist of what we want to go over today. Hopefully you all gain some knowledge about our program, but also about estimating and bidding with the federal government. And we enjoyed it. And we're here to take any more additional questions that you might have.
If you have any questions for Eric, you're welcome to put those in the chat, or you can unmute and ask them live if you'd like. Well, Eric, I'm not seeing any questions. Great presentation. We want to thank you very much. I do have just one quick question though for you. You mentioned your 3 tracks specific to assisting for the 8A preparation, the potential for success portion of that. What of those tracks, or are all of those tracks covered under the SBA grant for assistance for 8A?
All three.
All three?
Yes.
Okay, so there is no cost to the client to participate in those tracks.
Only their time.
Okay, thank you. Okay, well, I want to remind everyone too, while you're thinking, if you have any questions, that this session was recorded and you will be given an opportunity for an on-demand for it later if you want to go back over what Eric shared with us today. Okay, and you did have a thank you for your presentation if you didn't see that.
Righty. Thank you so much, Kelly.
Yes, well, thank you for your time today, and thank you for all of the participants that joined us. And so with that, we will close the session and we'll see you all in the next one. Thank you very much.
Great. Thank you.